and welcome to slide pack 12 of the financial modeling program. What we will talk about today is projecting the the balance sheet, and with that, continuing on what we did in slide pack 11 where we projected out the income statement. Now I will go back to the TPCC acquisition model that we had used earlier, and this time we'll talk about the balance sheet projections. Okay, so here we are. Now, what you see here is that we have actual data for 2010 as of December 2010, and what we are trying to do is build out projections for 2011 through 2014. What you'll also see on the right side in column P is that we have a whole bunch of assumptions that we've listed out so that it's clear to us as we build our balance sheet, and we don't have to go back and forth or look at some piece of paper to remind ourselves on what the assumptions were. And so it's clear to anyone that uses our model without us around. They can read through this and understand what the assumptions were that we made in building this model. What I'm going to do just for visual ease is I am going to collapse rows 2012 through 2014 using Excel's hide function, so we can see everything more in more of a compact single screen. Now we start out with the assets. So there's cash and cash equivalents. Now what you'll see here that to some extent may actually be slightly troubling to some of you on how the cash jumped so dramatically. So this is, and the assumption on the right hand says, this is a plug after the rest of the balance sheet was constructed to make sure that the balance sheet balanced. So for now, don't worry about this, and we'll come back to this later, but let me just show you one more thing. This plug continues through and through, and so it's just an assumption, and what we want to focus on right now is how the other line items were built up in this balance sheet. So if you look at the accounts receivable, what you'll see in column P is that the assumption is that this is based on DSO, and DSO, if you remember, was days of sales outstanding. What that basically means is if you take your actual sales and divide it by the number of days over which those sales happen, you get the sales per day. Now if you divide your accounts receivable or by the days of sales, by the average sales per day, what you'll get is a number for the days of sales outstanding. So if you look at the formula that we've used here, we've said that the accounts receivable is L54, and I'll use my F2 key. So if we go down to L54, you'll see that L54 is 23, which is an assumption that we have made for what we'd like to hold the DSO's assumption at. So 23 days is what we say our DSO is going to be. Now if you go back, so it says it's the DSO multiplied by the average sales per day. So it says TPCC income statement AG11 divided by 360. So if we go to AG11 in the income statement tab, you will see that AG11 is the total sales for 2011 divided by, so it's divided by 360 days in the year. So that's your average sale per day. So it's the DSO multiplied by the average sale per day, which gives you the balance on the accounts receivable. So this is an example of how the accounts receivable number is calculated on a balance sheet. Now, if you look at other line items here, such as the interest receivable, what we've assumed is that this is held constant. Now, sometimes you may not have enough data and you might have to make assumptions like, I just don't know enough about this, or I don't think this is going to change, so my assumption is going to be that I'm just going to hold this constant. If you look at notes receivable, likewise, the assumption here is that no new notes were issued by the company, and so we're just going to hold that constant, and the money is just going to be 10,000 year on year. Again, it's an assumption, and the assumptions will vary based on the specifics of your business. Now, the next line item is inventory. Now, we'd spoken about inventory turns earlier, and we will review this, but the note in column P says that the inventory number here is calculated based on the inventory turns. And if you look at the formula, it says it's the income statement AG13 divided by L55 on this sheet. So if we go to the income statement cell AG13, what you'll see is that this is the cost of goods sold for 2011. Going back to our balance sheet, what we are doing in this projection is we are taking the cost of goods sold for 2011 and we are dividing it by this number, L55, which is the inventory turns assumption that we are making. So what we calculated for 2010 was that the inventory turns is at a level of 16.9, and we plan to hold it at roughly that level. We'll just round it up to 17. So then we took the cost of goods sold for 2011 and we divided that by the inventory turns number to get the inventory that we have on hand as of the end of 2011 on our balance sheet. The next line item, parts and supplies inventory. Now, the assumption, which is probably a fair assumption here, is that your parts and supplies and the inventory that you hold for that really is sort of a function of the amount of selling that you do. The more that you anticipate you'll be selling, the more stock you plan to keep on hand. And so the assumption here is that this number is held constant as a percentage of sales. Now, if you look at the formula, it says it's assumptions E24 at the top there. In fact, if I press on F2, you'll see the formula. Assumptions page or assumptions tab, cell E24, multiplied by the income statement AG11. Now, recall AG11 was total sales for 2011. And if we go to the assumptions tab and we look at what we have in cell E24, I'm going to take this to E and I'm going to take this down to 24. So it says parts and supplies inventory 0.19%, and the ratio is held at 2010 inventory as a percentage of sales. So that ratio is highlighted here. People can change that ratio and any change you make will flow through the model. So that's how we projected out all of the items on the assets to get the total current assets. Now let's look at some of the other asset line items. Prepaid assets. This is money that the company paid out, and perhaps services are due, etc. So here again, the assumption is we've held it constant as a percentage of sales for 2011. Land and land options. Assumption: increased at the rate of $50,000 per year. So if you go back and look at assumptions E26. E26 is a dollar amount that is 50,000 increased every year. And if you look at the formula on this, all it's doing is it's taking the prior year, 2010's, land and land options number and increasing it by $50,000. So 2.781 plus 50 gives you $2.831 million. There are other asset items. Some are held constant. Some others are held constant as a percentage of sales. So for example, machinery and equipment or transportation equipment, it makes sense that as your company grows, perhaps at some percentage of sales, you'll be holding this roughly constant. So you may hold it constant, but then when your sales reach a certain point, you may want to buy some more equipment, and then you'd hold it constant. And then if sales reach another trigger, you might actually want to go out and buy some more. So here the assumption, and without going into the details, assumptions E28 has the percentage that we are holding this as a constant at. And we are multiplying that by the sales figure from AG11 of the income statement tab to, which is basically the total sales for 2011. So we've got machinery and equipment, transportation equipment that's held constant as a percentage of sales. We've got other items such as buildings, furniture, random stuff, ponds and roads, held constant. We're not going to change that because we don't expect that to change. Now depreciation. Depreciation is a function of the equipment that you have and that you purchase on a year-on-year basis. So the assumption for depreciation is that our equipment that we buy is going to have a 10-year useful life, and it's going to have a straight line method depreciation over 10 years. So using that assumption, we look at what the equipment is at a gross level, and we apply a straight line depreciation method to get the depreciation expense for every year. So if let's just say in 2010, if we had gone out and bought $5 million worth of new equipment, now $5 million of new equipment we will depreciate straight line for the next 10 years, which means 500,000 of depreciation expense on this new equipment piece alone. So we've tried to keep the math simple here. There are other methods of depreciation such as accelerated depreciation, which are also not that difficult to do. These are simple formulas, but we just want to sort of keep it simple and show you how we build out the various line items. Now, the other thing I want to point out is depreciation expense is slightly different from accumulated depreciation. Depreciation expense is what hits you on the income statement every period. But when you add up all the depreciation expenses on a particular equipment over time, that gives you your accumulated depreciation for each piece of equipment. And that is a balance sheet item, because your gross equipment purchase price less your accumulated depreciation is the net holding value of your equipment today in depreciated value terms. So then when you add all of that up, you get total assets. So that was how we projected out the asset side of the balance sheet. Now let's move to the liabilities. So what you'll see here is on the liabilities side, we have accounts payable. Now, accounts payable is money that you owe to your suppliers. And there are two ways of looking at this. You can either hold accounts payable constant as a percentage of sales to keep things simple, which is what we've done here. And the assumption is that your sales drives the amount of cost of goods sold. Because if you think back to cost of goods sold, it was basically a constant margin assumption that we made that was driving the cost of goods sold. And so really your accounts payable is tied to your cost of goods sold, which is tied to the suppliers and the contractors that you work with that you have to pay. So you can either hold it as a percentage of your cost of goods sold, or if all of it in any case is linked to a percentage of sales, you can just go with the percentage of sales here, which is what's been done in this model. Likewise, other payables held constant as a percentage of sales in row 31. Row 32, notes payable short term. Now the assumption here is that we are going to hold this constant because we're assuming that there's a certain amount that we just will be paying down every year on year on a large debt that we've taken on. So it's just held constant. Accrued liabilities, like a lot of other liabilities, the assumption here is that it's going to be held constant as a percentage of sales. So you add all that up, you get your total current liabilities. Payable to stockholders, accrued reclamation, notes payable long term. The assumptions here again held constant. You can keep it simple, or if your business demands that you change it, you can change it. And then with that we have our total liabilities in row 40. So we've done the liabilities portion. Now on the capital stock, the capital stock is held constant. The paid-in capital, which was paid in initially when the company started up, held constant. Retained earnings have to follow a formula, and the formula is very simple. It is retained earnings equals the prior retained earnings balance plus the net income for the current fiscal year minus dividends or distributions that you may have paid out this fiscal year. So that is a formula that you should keep in mind. And then if there are any adjustments here, we are just keeping it flat on the purchase accounting adjustment. We could very well have taken this down to 0. Again, depends on the specifics of your business. And that gives you your total capital, and it gives you your total liabilities plus capital or owner's equity. And then there are various notes at the bottom here, and then this is a very simple formula at the bottom that says are assets equal to liabilities plus capital or owner's equity. And it simply says if L27, which is the total assets number on this sheet, equals L51, which is total liabilities and equity, then just have a yes there, so I know it's balanced. If they are not equal, give me a no, so I know that there's an issue and I need to go back and fix it. So this, in a nutshell, and oversimplified, was how you can project out your balance sheet. So this is more of an introduction into the thought process that needs to go into projecting out a balance sheet. So we'll end the slide back here, and on the next one we'll move into projecting the statement of cash flows, which, to remind you again, is typically derived from projections on the income statement and projections on the balance sheet and any other assumptions that you might need to make. Thank you.